Most people don't lose money in the stock market because they picked the wrong stock. They lose it because they never asked the right question. Think about that for a second. Every day, millions of people open their trading apps, scroll through tickers, watch YouTube videos about the next big thing, and they buy. They tap that button with confidence, sometimes with excitement, sometimes with desperation. And then they wait. And most of them lose. Not because the market is evil, not because Wall Street is rigged against them, though that's a comforting story to tell yourself at 2 a.m. watching your portfolio bleed red. They lose because they skipped a step, a fundamental, non-negotiable step that separates investors from gamblers. Here's the brutal truth. Most retail investors don't have a strategy. They have a feeling. They hear a name, Tesla, Nvidia, some small-cap biotech that a guy in a Reddit thread swears is going to moon, and something fires in their brain. A little spark of possibility, of potential, of what if. And that feeling? It feels like research. It feels like conviction. It feels like the kind of gut instinct that made Warren Buffett a billionaire. It isn't. That feeling is just dopamine wearing a suit. You know what it looks like from the outside? It looks like a man standing at a roulette table, but instead of placing a chip on red or black, he's got a printed chart, 3 browser tabs open, and a highlighter. He looks like he knows what he's doing. He feels like he knows what he's doing. He doesn't. He's just a more organized gambler. And the market doesn't care how many hours you spent researching. The market doesn't grade you on effort. It grades you on being right. Here's where it gets worse. Most people who lose money in stocks didn't buy randomly. They bought intentionally. They watched the price go up for 2 weeks. They read articles. They checked the earnings reports. They did the thing that feels like due diligence, but there's a difference between collecting information and asking the right question. Think of it like building a house. You can buy the best wood, the best nails, the best tools on the market. But if you never stop to ask, is this foundation solid? You're just building something beautiful on top of sand. That's what most investors do. They decorate. They don't inspect. They look at revenue growth but don't ask who's driving it. They look at a stock chart moving up and to the right and call it a trend without asking why it's moving, or more importantly, what would have to change for it to stop. They're collecting facts without building understanding. And the market? The market is brutally efficient at punishing that gap between facts and understanding. We've seen it 1,000 times. A stock looks incredible on paper. Strong brand, growing revenue, buzz everywhere. People pile in. Analysts upgraded. CNBC puts it on the screen. Your brother-in-law texts you about it. And then something shifts. Maybe one assumption quietly breaks. Maybe the growth was built on debt that's now expensive to carry. Maybe the competitive moat everyone assumed was deep turns out to be a puddle. And the people holding that stock? They're blindsided. Because they never asked the question that would have revealed the crack before it became a collapse. Here's the thing about the stock market that nobody in a finance class will tell you clearly. Every stock price is a story, a narrative about the future, an argument that says this company at this price is worth owning because of what happens next. And when you buy a stock, you're not just buying shares. You're buying into that story. You're betting that the narrative holds. Most people buy the story without ever asking, what has to happen for the story to be true? And that question, that single, deceptively simple question, is the one that changes everything. It's not a complicated formula. It won't take you a degree in finance to understand it. But once you hear it, once you really understand what it's asking, you will never look at a stock the same way again. And you'll immediately realize why most people, smart people, hardworking people, keep losing money they couldn't afford to lose. The question is coming. But first, you need to understand just how deep the problem goes. You've been doing the work, the research, the watching, the waiting, and you're still losing. That's not bad luck. That's a broken process running on repeat. Here's the question that breaks the cycle. Before you buy a single share of anything, before you tap that button, before you commit $1, you need to ask yourself this: what has to be true for this investment to work? That's it. 5 words that will save you from more pain than any stock screener, any analyst report, any hot tip ever could. Read it again. What has to be true for this to work? Not, does this company look good? Not, is this company look good? Not, is the chart going up? Not, is everyone else buying it? What has to be true? Because here's what that question does. It forces you to stop collecting opinions and start building a case. It pulls you out of the feeling and puts you face to face with the facts, the real facts. The uncomfortable ones. It makes you name your assumptions out loud. And most investors, if they're being honest, have never done that. Not once. They've absorbed information, they've formed impressions, they've felt confident. But they've never sat down and said, okay, for this stock to double from here, what exactly needs to happen? That's where the danger lives, in the unexamined assumption. Think about what happens in your brain when you find the stock you like. You read something positive, maybe revenue is up 40% year over year. Your brain files that under good sign. You see the chart climbing. Another tick in the positive column. You notice a famous investor holds it. That feels like validation. What you're doing without realizing it is building a case for the stock, brick by brick. Every new piece of information that confirms your interest gets added to the pile. Every red flag gets minimized, explained away, or simply ignored. This is called confirmation bias. And it doesn't make you stupid, it makes you human. But the market punishes human just as hard as it punishes stupid. Here's the trap. The more research you do after you've already decided you like a stock, the more confident you feel, even though you're not actually getting safer. You're just getting more committed to a story you haven't properly stress tested. It's like a lawyer who only interviews witnesses that support their client. They can build a very convincing case. But in a real courtroom, the other side gets to speak. And if you've never asked hard questions of your own position, the market will ask them for you, loudly, expensively. The question, what has to be true for this to work, is how you become your own opposition. It forces you to flip the table. Instead of asking, why will this go up? You're asking, what must hold for this to not fall apart? Those are completely different questions, and they lead to completely different outcomes. Let's make this real. Say you're looking at a fast-growing tech company. Revenue is up. Everyone's excited. Feels like a sure thing. Now ask the question, what has to be true for this investment to work? Maybe you realize the whole growth story depends on them expanding into one new market. Okay, is that market accessible? What's the competition like? What's the timeline? What happens to the stock if that expansion takes 3 years longer than expected? Maybe you realize the valuation only makes sense if they maintain 35% annual growth for the next 5 years. Has any company their size ever actually done that? What would slow them down? Maybe you realize the founder is the entire brand. The vision, the culture, the investor confidence, it all sits on one person. What happens if that person leaves? Suddenly, you're not just looking at a stock. You're auditing a story. You're finding the load-bearing walls, the assumptions that everything else depends on. And you're asking, are these walls solid? Or are they painted cardboard? This is how serious investors think, not better data. Better questions. And here's what separates the ones who build real wealth from the ones who just rotate between hope and regret. The disciplined investor doesn't need to be right about everything. They just need to know what they're betting on. They know which assumptions their thesis rests on. So when something changes, and something always changes, they're not blindsided. They're ready. They either hold because the core assumption still stands or they exit because it doesn't. The emotional investor? They hold because they hope. They exit because they panic. Neither decision is connected to logic. Both are expensive. One more thing. This question doesn't just protect you from bad investments. It protects you from yourself. Because sometimes you'll ask, what has to be true for this to work? And you'll realize you can't answer it. You don't actually know why this stock should go up. You just liked the story. You just felt the pull. And that moment of honesty, that's worth more than any analyst report money can buy. But knowing the question is only half the battle. Because most people, even after hearing this, will still get it wrong. Not because they don't understand the question, but because they don't know how to answer it honestly. They don't know which assumptions to challenge, which ones to trust, and which ones are quietly hiding the risk that will eventually blow up their portfolio. That's where we go next. You know the question now. What has to be true for this to work? But here's where most people fall apart. They ask it. They nod. They feel smart for asking it. And then they answer it the same way they always have, with optimism dressed up as analysis. They list the reasons it could work. They call those reasons assumptions. They check the box and buy anyway. That's not stress testing a thesis. That's just confirmation bias with better vocabulary. So let's talk about how to actually answer the question honestly. Because honest answers are the only ones the market respects. There are 3 categories of assumptions hiding inside every stock pick. Most investors never identify them. The ones who do, consistently, are the ones who build real lasting wealth. The first assumption is about growth. Every stock that's priced above its current earnings is pricing in a future that doesn't exist yet. The market is saying, this company will be worth more tomorrow than it is today. And when you buy at that price, you're agreeing. So ask yourself, what growth is already baked into this price? Because here's something most people don't realize. You can buy a genuinely great company and still lose money. How? By buying it after everyone else already knew it was great. By the time a stock is on CNBC, on Reddit, in your group chat, the growth expectation is often already priced in. You're not buying potential anymore. You're buying the echo of potential. It's like arriving at a party at midnight and paying full cover charge. The best hours already happened. You're just paying for the cleanup. So when you ask what has to be true, start with growth. What rate of growth is this price assuming? Is that realistic? Has this company or any company like it ever actually delivered that? And what happens to the stock price if growth comes in at half that rate? Run the uncomfortable scenario, not the bull case. The realistic case, the slightly disappointing case, because that's the one that actually happens most of the time. The second assumption is about competition. Every business operates inside a battlefield, and most investors evaluate a company in isolation, like watching one fighter train in a gym without ever asking who they're going to fight. Ask this, what is this company's moat, and how deep is it really? A moat is what protects a business from being eaten alive by competitors. It could be brand loyalty, switching costs, patents, network effects, scale advantages. But here's the trap. Moats that look wide from a distance can be surprisingly shallow up close. And the market and new competitors are very good at finding shallow moats and exploiting them. So when you're building your answer to the question, what has to be true for this to work? Ask specifically, does this company have a durable competitive advantage, or does it just have a head start? A head start is not a moat. A head start is a countdown clock. Because if a business can be replicated, if a well-funded competitor can look at what they're doing, copy the model, undercut the price, and take the customers, then the story you're buying into has an expiration date. And you need to know when that clock runs out before the market figures it out for you. The third assumption, and this is the one that destroys the most portfolios, is about valuation. People confuse a good company with a good investment. These are not the same thing, not even close. A good company makes great products, grows revenue, and treats its employees well. A good investment is a good company bought at the right price. That distinction is everything. You can love a business and still overpay for it. And overpaying is a risk that doesn't announce itself. It doesn't show up as a red flag. It just quietly caps your upside and dramatically increases your downside. So the third question inside the big question is this: at what price does this investment stop making sense? Know your number before you buy. Not just the price you want to sell at, the price at which the story breaks. The point where even if everything goes right, the return doesn't justify the risk, because that number exists for every stock. Most investors just never bother to find it. And when you combine all three, growth assumptions, competitive assumptions, valuation assumptions, you stop being a passenger in your own portfolio. You become the pilot. You know what you're betting on. You know what would prove you wrong. And that means when something changes, when a competitor emerges, when growth slows, when the valuation stretches beyond reason, you're not confused. You're not frozen. You know exactly what to do. That's the difference between investors who build wealth quietly and consistently and investors who chase it loudly and expensively. The wealth builders aren't smarter. They're not luckier. They're not getting better tips or using better software. They just ask better questions before they buy, every single time. One question, 3 layers, and the discipline to answer it honestly, even when the honest answer means walking away. Most people won't do that. The story will be too good. The momentum will feel too strong. The fear of missing out will be too loud. But you're not most people. Not anymore. Because now you know the market doesn't reward the most enthusiastic investor. It rewards the most honest one.